Hello and welcome to episode 225 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, we've had a little break. We're back. How you doing?
I'm good. It's definitely a break. I'm not going to talk too much about the reasons for the break. Although it's safe to say that all the euphoria of football that you and I had over a couple of week period.
Distant memory.
It was a distant memory. There were apparently two finals that our respective teams were in. And
respectively lost.
We respectively saw them, yeah. So we'll be pleased to know the podcast is very much going back to the money theme with very little mention of football. So, but on that, Andy, we were actually going back to the previous episode. Anybody who listened to that one will remember that I think I was giddy with excitement. And I turned around and said, look, if you leave a review, anyone who leaves a review this week will get one of our Money to the Masses mugs and can appear on the mug wall of fame. And you joked, you're going to get like an influx, like 50 people. Well, about a few days later, I looked at our iTunes reviews, and I think we must be clocked about 30 in a matter of days on that one. So you were right.
Yeah.
And as a result, I'm true to my word. Everybody who left a review in that week is going to get the review. I mean, Andy's going to read a couple of them out. But before he does, if you left a review in that week, please email Lauren at moneytothemasses.com and claim your review. By that, I mean point out which one was your review. Because obviously we don't get your email. We don't know who you are. We see the sort of usernames on the iTunes chart, but we don't know anything more about you than that. So some of you did obviously get in touch and email us and say that was my review, and the couple that Andy's going to talk about.
Yeah, so thanks again ever so much if you did leave a review. We had a lot of fun reading through them, and I'm going to read a couple out now. Over the coming weeks, we'll read all the reviews out. We don't want to bombard everyone with hundreds of reviews. It'll be incredibly boring to listen to. But thanks ever so much to a British Canadian who left a review on the 21st of May. A great personal finance podcast. I've been a massive fan of this show since I came across it last year. Loved the show. Damien's advice and tips are very useful. Really liking the recent episodes with things to check when buying a house. Thanks and keep up the good work. Brilliant review, thank you. And one other one was Steve Lewis on the 19th of May. My Sunday isn't complete without it. I've been enjoying the podcast for at least a couple of years, and on the odd occasion it doesn't come out on a Sunday, I really miss it. Andy and Damien have an easy to listen to conversational style that educates with gentle humour, and any mention of a mug is entirely irrelevant to this review.
Well, the funny thing was we had a number of people there was a couple of reviews that said things like, I've always meant to do this. I've been listening for 2 years, and finally I'm embarrassed to say it's only because there's a mug on offer that I finally got round to it. So even if you're not going to get a mug now because the offer is finished, please leave a review anyway if you like the show. So it was fantastic. But the only other funny thing is I didn't really think it through far enough, because we are now sending a mug to Qatar. So we basically have got to try and afford all the posters and packaging for half of these mugs. But it was great to see everybody's enthusiasm for getting them and the wave of reviews. So please do keep them coming.
Good stuff. So let's move on to what we're here for. It's the podcast. We're back to talking about money. And actually, just before we do carry on with this podcast, you're going to mention, Damien, what we're covering in this week's podcast. Before we go on, we did mention in the last episode a couple of weeks ago that we were definitely going to cover a question from a chap called George regarding timing and strategy on investments. And we said we definitely wouldn't forget. Well, the good news is we haven't forgotten. But the bad news is we're not covering it because there's lots of other things going on.
Yeah. So what Andy's talking about, you'd have to be under a stone to not heard about Neil Woodford this week. And the supposed, I'm not going to say he's a guru or star manager. It's one of the things that gets on my nerves when I read it in the media. But his fund closed this week, and it's a big story. It's massive. I've had lots of journalists ask me for my opinion. You will have seen me in the press. You'll probably see me quoted in the press this weekend as well, talking about funds and the implications of what happened. So we're going to do a whole show around Neil Woodford and what's happened. It's not because it doesn't matter if you invest in Neil Woodford's fund. I don't, for obvious reasons. But there's a lot of lessons that have been learned from this episode in the market, and the whole thing to do with the closure of the fund that's happened over the lessons from a number of years that I think will be great for people to adhere to in the future and avoid similar mistakes. And it also shines a light on some of the things in the investment world that need to be looked at. So it's going to be my take on a lot of that. So it's definitely worth listening. It's not going to be boring Woodford loving, obviously, but there's a lot of lessons to be learned.
Yeah, so let's get on with it. And the elephant in the room, something's happened this week. Even people, non-investors or armchair investors that aren't really involved with Neil Woodford would have heard his name this week because it's hit the front page of newspapers and BBC News and things like that. So what's happened?
It was even on BBC News. I mean, it was the front page of BBC News. The only thing that kept it off was the commemoration of D-Day. So Neil Woodford is, if you believe the press and you believe the industry, he almost walked on water. He was a fund manager at a company called Invesco Perpetual. He used to run an income fund and a high income fund. He also manages mandates for St James's Place, which is one of the big advisory firms out there, and he had enormous amounts of money under management. I mean, you're talking about a normal fund may have 100 million, a couple of 100 million. If it's doing well, you might get to sort of towards $1 billion. Neil Woodford, in his heyday, probably had about 30 billion under management when he was at Invesco Perpetual. And so put that into perspective, a company like Nutmeg, which you see, are trying to grow their assets, and they're one of the biggest players in the robo-advice world, and they've only got about 1.5 billion. So that shows you that one man had so much money under his management. And the reason he did is that he was very successful for an incredibly long period of time. He was credited for missing the dot-com bubble, so he didn't have technology stocks when the dot-com bubble burst in the early 2000s. He didn't have financial stocks when the financial crisis came along. So it meant that his performance over a long period of time was great.
And when you say long period of time, we're talking way back to 1990, right?
Yeah, and so that's an incredible period of time. And it was that level of consistency that meant that people would follow him and do whatever, he invest in his funds. So unfortunately, there's this element in the financial services world of following fund managers. Because, yeah, obviously, if somebody has invested money and you've grown it over an extended period of time, I mean, his returns were brilliant. There's no two ways about it. But of course, every dog has its day. And unfortunately for Neil Woodford, his day of reckoning has happened just now. Because after that stellar performance, you see these stories telling you how Neil Woodford had turned £10,000 into like how many £100,000, £200,000 over 20, 30 years or something like that. It's all those sorts of numbers you see. And so he's always called a guru, a top stock picker and stuff like that. In 2014, Neil Woodford decided to go it alone and launch his own investment management business. And he launched 3 funds at the same time. So there was one called the Woodford Equity Income Fund. He had one called the Woodford Income Focus Fund and an investment trust called the Woodford Patient Capital Fund.
Can I come in on that just from a guy who doesn't know much about investment? How does that work? So before he was managing money for a company, and because of his success, he's basically able to go in and create his own fund.
Yeah, so what happened is he worked for Invesco Perpetual. So it's a fund management group. They have lots of funds with lots of managers.
As an employee of theirs?
As an employee of theirs.
Right.
So that's what he did. And he ran these particular funds very successfully. But of course, then it got to a point where he's then decided later in his career that he was he didn't want to be there for whatever reasons. He decided that, and he was going to create his own management business, wealth management business, and launch his own funds that he would run. So he launched his own competitors, say, to Invesco Perpetual, but the only funds are his. And it was called, he had his name in the name of the asset company.
If I was to use an analogy, would that be someone who was maybe, let's go into the TV world, who's an employee who worked for a TV program, but then they decided they were so famous and successful in themselves, they launched their own production company and managed it all themselves.
Yeah, exactly. And so why would you do that? Because you make more money, or he does. But he also therefore had more freedom to be able to choose what his mandates were. So when that happened, it had a huge fanfare. Go back, Google it. You can go back and look at your Google timelines to 2014. So you can just, when I say that, if you go and Google it, you can choose the period of results you get. And the Woodford fund launch, it attracted billions on launch. I mean, that's unheard of, but such was the pull of the man, but also such was the drive by different fund platforms to be able to make money out of it. And also there were headlines for the newspapers. Like when, for example, you get a company might list on the stock exchange, they drum up excitement for these things so people will invest. And that's because as a broker you make money. And obviously Neil Woodford was wanting to drum up interest because he wanted people to leave Invesco and come to his new fund because he was going to run it on a similar mandate initially. So that's what happened. So it was a huge event in the sort of fund management industry. At the time I was incredibly cynical about the whole thing because I don't follow fund managers. As you know, if you listen to this, don't follow fund managers, never, because every fund manager has a process that works in a particular period of time. Now, take Neil Woodford. Neil Woodford typically invested in things like tobacco companies, pharmaceutical companies. So they were good dividend payers. They were defensive stocks. So in a correction that we had with the dot-com era and we had in the financial crisis, they weren't the sort of things that were going to be hit by that. They were defensive stocks. So he performed well. What it meant, though, is that when the market changed and when the market started to become much more of a growth-orientated market, when QE came along and started just inflating almost everything, some of those stocks lagged. And Neil Woodford is what they call a contrarian or value investor. He will go and also look at things that are unloved, and he will start to try and buy them because he thinks they might be able to one day be worth more money. And he did that especially so in his new funds. But of course, in this recent environment, being a value investor has actually been a tough place to be. You end up better off just buying what went up. You're buying momentum, buying the trend. So what happened, we got to 2014, Neil Woodford launched his fund to great fanfare, great success. Money flowed in. He started running it on a similar basis to what he run his successful Invesco funds, and the fund took off. I mean, it did well. It was top performing for the first couple of years. But then he made a series of bad bets. There were a couple of investments that he made in different companies that didn't go well. That's life. That happens. That's why you have a broad range of investments as a fund manager. But he made perhaps more than his fair share at that point. There was always a debate. I was actually going to do a podcast about the impact of luck on investing. There is definite luck involved in investing, and you get the good luck and bad luck. Neil Woodford had a bit of bad luck. But what started to compound things is that as people started to question the performance, because the performance downturn was significant. If you look at where it is today, so the fund was 5 years old, almost to the day when it shut this week. The fund's performance plummeted. So say he was up 30%. He actually is now at the point where he made no money. You would have been better getting your money and putting it under the bed than giving it to Neil Woodford. And this is the guy who's the star manager that had billions of pounds pumped in, influenced by the media, fund platforms, financial advisors. They all loved him. He could do no wrong. And so they've all now made no money out of his fund. And that's if you invested at the beginning. If you'd invested in the last couple of years, which lots of people would have done, you'd be massively down. And that's incredible. We're talking about in the last, say, 3 years, since late 2017, you'd be down more than 20% on his fund, which is now closed, as opposed to the rest of the market, which would be up significantly. So you were losing money is the point. But what compounded the issue for Neil Woodford, as some investors started to lose faith in him and started to pull money out, it was a unit trust. It was the Woodford Equity Income Fund that ended up having the problems. And it's important that we highlight that, because the way a unit trust works, it's a fund. So when you want to buy into it, the fund manager creates new units out of thin air, and then that money you give him is invested along with the mandate of the fund. If you want to sell units, then you sell your units back to the fund manager and you receive cash. So it's the fund manager sort of manages the inflows and outflows. That's very different to an investment trust. An investment trust is closed-ended. So a unit trust, you hear them, they're called open-ended. So there is no finite number of units. With an investment trust, it's basically like a company that invests. There are a finite number of shares in an investment trust. So if you want to sell them, you sell them in the open market, and there is a price at which you get because you sell them to somebody else. With a unit trust, what happened for Neil Woodford is that if the withdrawals become so large, they start to impact the fund because they have to start selling assets, liquidating things to get enough cash to pay you. Whereas an investment trust, that wouldn't occur because you would end up, if you want to sell your shares to somebody else, they'd have to buy them.
Yeah.
So in the open
and there'll
market,
be a price for it.
There'll be a price for it, and it might be discounted.
Yeah.
But with a unit trust, you can get this spiral that happens. Now go back to Brexit. Do you remember the property funds closed their doors because everyone wanted their money out? And it was because there were illiquid assets in their property, which you can't sell half a house or half an office block. So therefore they couldn't raise the cash. So what they did, they had to close the fund and say, sorry people, this is impacting the performance of the fund now because we're having to sell things at a fire sale. we're going to have to close it. Neil Woodford had the same thing, and you might be thinking, well, hold on a second, but didn't he just sell the shares he owned and stuff like that? Yes, he could, but he had illiquid stuff in there. By that means things that aren't easy to sell, so shares in very small companies. But the problem started to arise fairly recently because there are rules by the FCA that say that funds have to comply with a maximum of, say, 10% illiquid assets in tiny companies or that are difficult to sell. Neil Woodford, he stayed within the rules, it seems. The FCA are now looking into whether he did actually, but it's been stated in the press that it may have actually got up to about 18% of the fund was in these liquid assets. And part of that was because he actually held some of the assets in Guernsey. And it's a bit of a convoluted story, but basically by holding them on a slightly different stock exchange, they were still classed as listed, even though they weren't listed in the normal stock exchange in the UK. And so it meant that they were technically liquid, but then the Guernsey Stock Exchange suddenly decided those particular shares, those companies weren't allowed on there anymore, and then suddenly his illiquid assets went up. Cut a long story short, he had more illiquid assets that then could handle the withdrawals from the fund. As the performance of the fund was dipping because he made some bad bets, the level of liquid assets meant he couldn't meet the redemptions. So therefore he got to the point where he was having to sell pretty much anything that was liquid at a fire sale. There was a danger of that. So there were people out there who knew how much Will Woodford had in his fund. He had billions of assets that he was starting to have to liquidate to try and get cash to give to investors. So people on the other side of that trade, the smart people, were going, I'm going to basically short the stuff that Neil Woodford is probably going to have to sell, or I'm going to offer a low price. And so therefore it was a vicious circle. It was almost like a doom loop. It was an inevitability that he would either completely liquidate and go bust and all the people lose money, or he had to close the fund and say, right, investors can't get their money out. Your money's stuck in my fund now, so I can't have to handle this withdrawal issue anymore, and I can now start managing the fund again, and hopefully every 28 days we can review this, and then hopefully I can get to the point where I can open the fund again.
Right, so that's brilliant. You've explained, for someone who was reading all this, not quite getting it, I get it now. So from 2017 on, this was bombing. People kind of got wind of the fact that this was not a good thing to be. How come then that it's all come about now? You know, why wasn't something done sooner, I suppose, is what I'm asking.
Yeah. So what happened is the fund was being heavily promoted. They got big marketing machines. The press still talk about Woodford and run stories on him saying you should stick with Neil Woodford. He's got a period of underperformance. All fund managers do. Platforms were heavily promoting it. And don't forget that platforms do make money from the funds that you buy. So it's in their interest to promote funds. So it would be one of the funds that would be on their best buy list. That was also an issue.
Even if it wasn't performing well?
Well, yeah, because obviously all funds are going to have dips in performance. Not every fund's going to make money in every market condition. So underperformance is not unusual. You're going to have that.
Right.
But the point was, this was almost like, there's a newspaper I was quoted in, and they pulled out my quote of it being a slow motion car crash. Because it was going on it was almost steadily downwards for the best part of 2 years. But at the back end of 2017, Jupiter Merlin pulled about £300 million out of the fund, because it wasn't just retail investors like you and I invested in the fund. I mean, I never invested in the fund, and anybody who listened to me wouldn't have done. But I'm talking about ordinary armchair investors that invested in this. This was institutions that invested in it. This was fund of funds, so big other funds would invest in his fund. That's the level of conviction.
That's the bit that I don't get. It's like Inception. It's funds within funds.
Yeah, and so they had started pulling money out, and they pulled, for example, £300 million was one of the mandates that got pulled out at the back end of 2017. Now, that isn't going to happen if they weren't worried about it. And
these are kind of educated people who know what's going on in the market.
Yeah, and they came out and said they saw some mean reversion coming along. By that I mean the fund had done well and outperformed massively at that start when Neil Woodford launched these new funds. And that one in particular, I'm talking about the Woodford Equity Income Fund. I'll come back to the other two. This is all about the Woodford Equity Income Fund, because this is the one that's impacted. The others aren't, and I'll explain why in a minute. So there were signs that people weren't happy about it, so the institutional investors. And so that would have been going over some time. But ironically, what ultimately closed the fund was Kent County Council pulled... I mean, you might sit and think, what, councils invest in funds? Yes, they do. They invest in funds as well.
Well, at least us two aren't impacted by this. We don't. Oh, hang on a minute. We both pay money to Kent County Council, don't we?
You do. I don't.
Oh, do you not?
No, I'm in Greater London, Andy. So they pulled
up again.
They pulled about 250 million, I think it was, just last week from the fund, because they decided the Woodford's Equity Income Fund, the performance, it had enough. They pulled it out. That's a serious amount of money to pull out, and that's what eventually triggered Woodford to have to close the doors because they couldn't cope with the withdrawals anymore because of the level of liquid assets they've got. So it was something that was almost inevitable in the end. There were questions being asked all along. There were people pulling money out of the fund. The fund was hemorrhaging money. The only thing that really didn't make it happen sooner was because Woodford still had a very positive reputation in the industry, and he still had the positive pieces written by him by the press. If you go to the national press, go and look, This Is Money wrote a piece that was quoting a third person talking about why you should stay invested in the investment trust, which I say is not impacted by the closure, but it's basically backing Neil Woodford days before. It raises the question, why would you publish that? I would never publish something like that, Money to the Masses. Neil Woodford's fund would never have got near the 80-20 investor best buy list. It's never been in any of them. Because if you have a process where you look at a fund and you're sitting there thinking, this fund is the bottom of every metric you want to look at, why would you buy it? And the only reasons that anybody would give is because they believed in Neil Woodford. They thought that he would come good. My argument to that is he may do. He may have done. Every dog has its day, but why not invest in the other people who are doing well in this environment? And if Neil Woodford would eventually do better in another environment, then invest in him in that point.
And is that the whole momentum process?
That is what I'm talking about, momentum. But just generally anyway, if something's not working and it's consistently not working, you have to have a process to review it. If your financial advisor didn't question why he was holding Neil Woodford, then personally I would argue you need to go and get another financial advisor, because he was either believing some hype or he was basing his investment decisions on something that was emotional, that basically, he's a good guy, he will come good. Sometimes, even if you are a good guy, you are a good investor, or whatever it may be, sometimes things will work against you. He made some bad decisions. He invested in illiquid assets, which in a unit trust, it does raise some questions. So this is all the sort of learnings that we're talking about from the Woodford saga.
Okay, so we mentioned a couple of times now that the Woodford Equity Income Fund is closed. Woodford made that decision. It's been closed. What does that actually mean, closed?
So you can't get your money out. You can't buy it. You can't sell it. And if you're in that fund, that's kind of tough because you've got to sit on your hands and wait for it to be reopened.
Do investors know that that's an option? I mean, this is quite unusual, right?
Yeah,
this doesn't happen every day.
This doesn't happen every day.
So for me, being a novice investor, I wouldn't even know that they had the power to just shut it off and say you can't have it at the moment.
Yeah, don't forget though that the reason they do it is to protect the people in the fund.
Yeah.
So if you imagine that everybody's sort of bolting for the exits and you want to stay and have faith with the manager, if he's having to sell things at ridiculously cheap price just to give people who are leaving their money, what it would do is it would leave you in a fund with basically not a well-managed portfolio. It's just anything that's kind of left. It's like you going to Tesco's when everybody's gone and said it's going to snow and they've taken all the food and you walk in there and got what's left on the shelves. It's like kind of, do you know what I mean? It's that. You're left with like the dregs. And that's what would happen with a portfolio where they don't close it. And it is unusual for an equity fund to do it, particularly at the top of the market. I mean, we're not at the top of the FTSE 100, but equity markets globally are still sort of not far from all-time highs. So for an equity income fund to close in that environment is incredible. And it does start to raise questions of whether that there's some sort of systemic issue that might happen with this. Because go back to 2008, the financial crisis, there were things like this that occurred early doors where hedge funds were collapsing. I mean, what would happen if the stock market collapsed or fell 10% from now? Then would other funds have to close? Because at the moment, all the equities and everything sort of more buoyant, you should be able to stave off things like this. But what happened, unfortunately, for Neil Woodford is that he then got himself into a loop and he's closed the fund. And for investors in it, that is protecting their money and he should be able to manage it and hopefully reopen the fund at some point and the fund will have recovered and it will be how he wants it to be, because he's actually said he's going to get rid of those illiquid assets. He's going to manage it down so they aren't in there anymore, which is an admission of an error in my view. And so he's going to rectify that. But the problem is when he opens the doors again, if he ever does, there's no guarantee he ever will be able to.
A lot of people will head straight for the exit.
Yeah, so he's going to have to talk to any other institutional investors that have got large mandates, that they don't start pulling them. So if you're in the fund, then hopefully it's only a small part of your portfolio and these things can happen. Look, property funds closed after Brexit, like I said. And if a fund closes, typically you could be waiting about 18 months. for it to reopen again. Wow. It's not always, but that is something you're likely to see within a year, 18 months. But it can happen much quicker than that. Brexit, for example, with the property funds, a lot of them opened months later, sort of 6 months down the line, they reopened again when the sort of dust has settled. This is a slightly different scenario because it was more of a question around the asset class with the property funds and whether people would want to be buying commercial property in the UK, whether companies would be relocating to the European Union. It wasn't specific to the fund and the way it was being run. That's the difference. So I was asked by journalists, like, what should people do? Should they just, as soon as it open, exit? Now, I can't advise people what to do. This is not advice. But if my money was in the Woodford Fund, I would be sitting there building a shopping list about what I'd want to get into, even if it's just cash, for when it does open. Because I would sit there and think, do you know what? I would be thinking I would want my money out to be able to invest it somewhere else.
When it does reopen, how does it work in terms of the actual price? Like, does it immediately open at a much lower price? Like, because everyone's going to dash in there and try and...
Yeah, it's a good question because they're still pricing it. So if you're in it, you're going to get daily prices from Woodford. He's going to price what the value of the fund is. So you can still see it. You just can't do anything with it.
The price will still move, even though it's closed.
Yeah, right. So all it is saying is you can't come in, you can't leave. But there's still something going on in there, and they're still pricing it. So it's not a disaster if you've only got a small holding in it and he managed to recover it. My concern is, which is shared by quite a few other people, is whether we'll ever be able to do that. So you're going to have to sit on your hands. There's no point sweating about it now. It's done.
It's kind of a situation where you're watching your house burn. You can't do anything about it, and you're just hoping that the fire brigade are going to turn up and put out the flames. Good idea or bad?
Well, it could be, but you might be able to get something. Well, it is perhaps what it's going to be, Andy. It's a similar analogy, but you go back and see what you can save. When Notre Dame,
like a phoenix from the flames.
When the Notre Dame's roof was burning down, people were wondering. The first question was what survived, and I think we're getting a bit of that with Neil Woodford.
Good stuff. So you mentioned earlier about two other funds. What's going on with those?
Yeah, so the Woodford Income Focus Fund is a different fund. It's a unit trust again, but it doesn't have the liquid holdings. So he's been at pains. Woodford doesn't highlight the fact that they shouldn't have the same problem because if you want to withdraw money, you can. It's not closed yet. Will it be? I'd be surprised if it didn't, only because if everybody's now anti-Woodford, which they seem to be, then people might start pulling money out of the fund. But it's not, so you don't technically have to panic about that because your money's not stuck in. But I can only say if my money was in the Woodford Income Fund, then I'm not going to go in the national press and say to people, oh, I'd pull my money out. I'm comfortable saying on the podcast, if it was my money in it, I would probably want it back. I would have been in it in the first place, but quite frankly, I would have been worried about it. The investment trust he had, again, is a different animal because there isn't the issue with the illiquidity. If there are illiquid holdings in an investment trust, it's not the same thing because where people can buy and trade the shares in the investment trust, you're trading with other people, so it's not the same. There's no false selling going on by the manager. It's not the manager giving you your money back. You're getting your money from another investor. So again, that's not a reason to panic. But the problem is that those two, the fund and the investment trust, they only just added together only about $1 billion. I say $1 billion, that's quite a bit. But given that the Woodford fund was about 10 billion not too long ago in size, it's now got down to probably about 3 to 4 billion. It's about 3.7 billion when it closed. And Woodford had the other issue that St James's Place used to allow him to run some funds for him on a similar mandate. They weren't closed, but they've just turned around and said, you know what, Neil, I'm not having this anymore. They've got some other managers in. So half his money he was managing elsewhere that he had under his management, in inverted commas.
He could influence.
Yeah, he did. That's now gone to someone else. That's how far his star has fallen. Now, the lessons that I want to talk about are about the whole story of Woodford. So don't believe in fund managers. Don't believe the press when they talk about big up fund managers. Always query what the story is. What's the purpose of the story? Is there any use of this story other than to promote a fund manager? I want to tell you how journalists work, right? I work with journalists and talk to them, and they've asked me for my opinions on Woodford. And this isn't, I've been told by other people not to sort of say what goes on in the press sometimes. But this isn't a criticism, it's just how it works. So sometimes journalists might decide they don't want to be financial journalists anymore because they're not always that well paid. They know lots about money, they've written about funds, so where would you go and work? You'd become the PR for fund managers. I know a number of them that have become the PR people for fund managers. And they make good PR people because they know all the financial journalists because they were their friends in the national newspapers. So what happens is the PR people are placing stories in the press. They go to them, they talk, they try and get stories in there. It's not saying that they plant them and write word for word,
No.
but that's what PRs do. You go and talk to people, you take them out for lunch.
But of course, from a financial journalist point of view, if someone's there and is pretty much, passing you a story that's 70% written and you just need to sprinkle some dust on it and make it, a rounded piece,
Yeah, but that's,
then why wouldn't you?
Yeah, and that's the way personal finance works. So if you look at any of the financial newspapers, you go through them this weekend, you will see stories that you could work out who are they either promoting or kind to, or what is the purpose of the piece, where did the research come from that was in it. You can see that actually they serve a purpose. They might interest you, they might slightly inform you, but usually a lot of them can sometimes be almost quasi-adverts without being disclosed as such and paid for as such. So that,
and that's how the world works. It's not a bad thing, is it?
No, but I do think they need to look at the influence that they have on investment worlds, particularly when people buy and invest money. Because why keep talking up something that was clearly, like I said, a slow motion car crash? There was no way that anybody, if they looked at it, could see that what was going wrong with Neil Woodford. The other lesson is you need to have a process by where you evaluate funds. I've done a podcast on when you look at a fund and you decide when to remove it or when to make a decision. The other thing is you need to question what your financial advisors do when they pick your funds. The best buy tables you see at platforms, Hargreaves Lansdown has come in for a lot of criticism on this story because they were still promoting the fund right up until the day it closed on their best buy list, and I can fully understand that, and I think they should have a long time ago taken Neil Woodford out of their best buy list. I mean, what happened was that when they shortened and reduced their sort of Wealth 50, they now call it, from a much bigger list to a smaller list, there was Terry Smith, who's a famous fund manager, who is unfortunately starting to be put on a pedestal like Neil Woodford was. He came out and criticised Hargreaves Lansdown for the fact that he wasn't included in their best buy list, and he said it was all down to commercials. Now, that was his accusation at the time. And the thing is, what it really does is it emphasises the fact that best buy lists, you should take them with a pinch of salt and do your own research. I think what's going to happen now, we're going to see the FCA look into this, because where you've got all the platforms out there, they make money from the funds that are on their best buy lists. And that leaves them open to accusations of being slightly disingenuous sometimes with what they recommend. But not just that. It's actually the point where if a fund platform has undue influence on a particular fund, let's say they decided that this fund was no good anymore and they took it from their best buy list, then they could ultimately close a fund much like the Kent County Council did if it was in a downward spiral. So that, I think, is going to be something that we're going to have to look at. So I have said before, best buy lists are only good at looking at just as a cursory way to see what's out there, but you can compare across different platforms if you really wanted to. Neil Woodford wasn't on many of them. They weren't on Interactive Investor, for example, but that's partly because Interactive Investor didn't have a best buy list at the point where Neil Woodford launched that fund. So I think you've got to take that into the round. Rating agencies were another one. Morningstar, weeks ago, cut him down from a bronze rating to a neutral rating. And if you go onto Twitter, I was moaning about it. I was highlighting, going, well, what do you have to do to be negative, which is their lowest rating? Lo and behold, after the fund had closed, they've given him a negative rating now. So again, it starts to raise questions about the usefulness of some of this rating stuff. If they are shutting the door after the horse has bolted. I mean, like I said, it was obvious. It's slow motion stuff. It raises the question about unit trust versus investment trust. I think we're going to see a lot more about whether people should be buying investment trusts. We should now start seeing people actually talking about illiquid assets and why they should only really be held in investment trusts rather than unit trusts, and the problems with unit trust versus investment trusts and the sort of positives and negatives of each, which we've done on a podcast. And I think we're going to have to look at the influence of the press in all of this, because despite them now chucking mud at everybody that's been involved in getting us to the point where Neil Woodford has managed to basically shut all his sort of money into a fund and it's all gone wrong, the press did have an influence, and even to the point where after the fund had closed, the BBC ran a story saying top stock picker Neil Woodford. Well, by definition, he was bottom. And I think we just need to start calling it what it is. I know it doesn't make it interesting saying failing fund manager or underperforming fund manager closes fund, but I do think we need to stop using words like star fund manager, fund guru and stuff like that.
So I suppose before we finish the podcast, we should mention Neil Woodford. It's been about him What now for him? What is the future? Obviously, he's had this star status. Can he recover?
I'm not convinced, because it's not the fact that he was necessarily doing anything different to what he did before. I know he did these illiquid holdings, but I think with Neil Woodford, it's just when you get a sort of a vicious cycle like he's in, it's very difficult to stop it. Closing the fund did it, but I'm not convinced. It could be the point where it's the end of it. I do honestly think there's that risk. But if you're in the fund, you've got to give it time. You've got to sit on it, see what happens, and you can only make a decision about what to do with anything when it comes to the point that the fund reopens. We've got to see what happens. But it is just a timely reminder to people to look at their funds, look at what their holdings are, be diversified. Don't put too much money into one particular fund for this reason, because if you do, then they could be locked in. And the other thing is, if you're looking for alternatives, then 80/20 Investor does an awesome equity income heat maps that talk about dividends and all that kind of stuff, which is what I used when I was giving commentary for Woodford Alternatives to the press this week. So it's not just a plugger for 80/20 Investor, why I'm saying this, but the whole point is that it's about giving people a process that allows them to make informed decisions of their own and be aware of things like this, but also where we're not making money from what they buy and what they hold. That's why we made it like we did. It's just an idea of research and informing people, because I think that needs to be separated. And I think in time, the industry and the platforms will be forced to separate their research away from the ability to actually buy funds, or it'll be more heavily regulated.
Well, I tell you what, Neil Woodford's ears must be burning, because it's very rare we do a special on one person or one thing or one specific. But it's been a mad week, isn't it?
It has been a mad week, and I think people shouldn't underestimate the size of this story, what's happened, the importance of it. It is, I mean, even in America, they're sitting there and they're looking across over us thinking, oh my God, is this going to start the next financial crisis type of stuff? Now, that's a bit early doors, but they are worried about the fact that one of the biggest fund managers in the UK, the biggest stars, has had to basically close his fund, even when equity markets and the highs and even central banks are pumping the world full of easy money. That worries them. So don't underestimate this story. It's going to have a lot more to run, and we'll see what happens in the future.
Good stuff. So if you haven't heard it already, make sure you listen to this week's Midweek Markets that came out on Wednesday. We kind of touch on Woodford a little bit there, but Damien talks about his 80/20 process and why he is up in a period where everyone else is struggling.
Yeah, and technically, I just thought of one other thing. The investors in the fund are obviously feeling like they're sort of losers in all of this. But one other thing is that the companies that Woodford invested in, so those small companies, have also been impacted, because where it got to the point that they were having to sell holdings, or people are circling thinking, yeah, at some point he's going to open this fund and what he's going to have to sell. The share prices of those companies have fallen because they know Neil Woodford's got them. Yeah. So that's impacting those companies too. So it goes beyond just the fact that people are stuck in a fund. There are ripple effects that go out beyond just simply Neil Woodford and his fund, because of the influence and size that start to sort of bounce around the market. So we may have more stories that come out of this in the future, but if nothing else, it's a very interesting and topical piece.
Good stuff. So if you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Get in touch on Twitter. It's at moneytothemasses with number 2. Get over to Instagram. We're doing lots of stuff. If you haven't won a mug by putting your review on iTunes, you may well win a mug over at Instagram, because we run various competitions over there. Again, just to reiterate, if you have reviewed us in that period where we're offering free mugs, claim your review by emailing Lauren at moneytothemasses.com. If you want to email me, you can do so. Don't know why you would, but it's Andy at moneytothemasses.com. Damien, we're done, aren't we?
We're done. Until next week.
Until next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Play. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.